Hey, what is up, stock compounders? Brad here. So we're going to do a question and answer session today. And I've got some pretty awesome questions for you, I believe, here. We've got 5 questions. A couple of them I kind of made up based on recent comments that I've gotten, and a couple I pulled off of that Facebook Value Investors group. So let's dive right into it. Question 1, is SRG a buy? So we all found out Monish Pabrai bought about 5% of his total assets in Pabrai funds was put into Seritage Growth Properties in May of 2020. So that's a pretty big stake to be buying all at once, kind of in 1 month. So he has owned SRG before. I believe it was 2017 that he owned. He sold that position because he was worried that Sears was heading pretty quickly towards bankruptcy and that would negatively impact Seritage Growth Properties, which was a spinoff from Sears back in 2015. So, Pabrai for many years had been investing kind of following the model of I want to buy cheap businesses where I can get a double in maybe 2 or 3 years. Just in the last couple of years, he's really shifted his investment focus to finding companies with hidden moats, okay? Kind of hidden PE of 1 companies that are actually long-term compounders. And he's looking for like a 5 to 10x jump in the stock, generally within 5 years or so. So the fact that he bought quite a bit, that he took a fairly large position in Seritage Growth Properties this year indicates to me that he sees a pretty asymmetric reward to risk ratio in Seritage Growth Properties right now. A low risk of downside in the case where they have to liquidate all of their properties to pay off their debt from Berkshire Hathaway and pay off kind of the operating expenses. That's kind of a worst case scenario. They have to liquidate all of their properties. And I think they'd be fairly close to break even if they had to liquidate everything. Whereas if they're able to develop a lot of these properties into, these massive cash flow generating real estate assets, there's definitely potential for a much bigger upside. Back in 2017, he was thinking the real estate assets could be worth about $12 billion. Okay. I don't know if he has as rosy of an outlook today as he did then, but if you look at the market cap of the equity right now, it's about $500 million. Okay. The debt is about, it's a little bit more than $1.5 billion. So with the equity and debt around $2 billion, if you have $12 billion worth of assets, say 5 to 10 years from now, that indicates a massive upside in that stock. So, I've started to put a little bit of money to work in SRG stock. I've really been diving in to try to understand the business better, to try to understand what the upside is for kind of developing these properties and how long that might take given our current economic situation. So it's a really interesting play for me right now. I have put a little bit in. I can't really recommend it. I don't know enough about it yet, but I do know enough about kind of what Pabrai needs to see in an investment opportunity before he buys to kind of make me comfortable putting some money to work in SRG at this point. So, I'm not recommending it as a buy, but it's certainly compelling, and I'm diving deeper into it. Question 2, what is the most important quality for a great investment, right? If there's kind of, how do you distill down to its essence, this is a great investment? And probably the easiest way to do that is something that Warren Buffett once said. He said, the most important thing we look for is the ability of the business to reinvest earnings and consistently generate high return on capital on those earnings. Okay, so this goes back to that kind of magic metric, return on invested capital, which Joel Greenblatt uses as one of his 2 metrics in the magic formula. There was a post by the author of 100 Baggers, Chris Meyer. He wrote a blog post recently on invisible moats and how to find companies that have these hidden or invisible moats. And really what he's looking for is companies that are able to generate high return on invested capital for, many years. And that's, ideally 20% or more return on invested capital. Companies like Costco, Facebook, Microsoft, Google, the Amazon, they all have high return on invested capital. So that's the answer to that one. Number 3, what does stock price tell you about a business? So, looking at what Robinhood investors have been doing lately, it seems like there's so much chasing stock price. So for someone who doesn't know much about investing, it makes sense that, all right, if you're looking at a business and the price is going up, it makes sense that might indicate to you that this is potentially a good investment. There are other people who are voting with their dollars that this company is a good investment. That's why the price is going up, because there's more buy demand than there is sell demand. So for the novice investor, it's compelling to chase price. When we see a company's stock price going up, there's social proof in that. There's kind of this herd, there's people flocking to that stock. And so the price is going up, and that's kind of making people feel more comfortable with that stock, that there's all of these people who are also buying it. The problem with investing is that as the price of a stock goes up, the investment prospects go down. Okay? The more you pay for an asset, the less your expected return on that asset is going to be. All right? That's just kind of fundamental investing principle right there. So, Warren Buffett would say stock price doesn't tell you anything about a business. The stock price tells you, about the investors and speculators who are buying the stock, whether they're excited about that stock or whether they're, kind of fleeing from that stock. It's kind of the fear and greed coin. Which side of the coin is up? People are fearful, they're running away from it, stock price is dropping. People are greedy if they don't want to miss out, if they, think it's going to keep going up, then they're flocking towards it. So price tells you about the people who are buying and selling stock. It doesn't tell you anything about the business. Of course, stocks just represent a partial ownership in a business. So, all of these people making buy and sell decisions based on what the price is doing, that's gambling to me. I don't look at price when I'm trying. I don't look at changes in price when I'm trying to decide whether or not to buy something. Like there was a lot of hype around airline stocks because, the price had dropped say 70 or 80%. And people look at that and say, well, if it dropped that far, maybe in the near future, it's going to go back up to where it was. And of course, it's not hard to understand the rationale behind that, but that's really not how things work, okay? So price doesn't tell you anything about a business. And if you're buying based on what the price has done recently, you're speculating, you're gambling. And I would encourage you to find kind of a different way to gauge whether or not a stock is a good investment than just by looking at price history. And the way I do it, of course, is to try to get a sense of what the business is worth and what that partial ownership in the business is worth, which is what stock represents, a partial ownership in a business. And that's really the intrinsic value of the business. And of course, there are ways to calculate that by, looking at the income statement and the balance sheet for a business, understanding the financials of a business and the management, of course, to make predictions about what's going to happen in the future, reasonable predictions. So anyway, price doesn't tell you anything about a business. Question 4, what investing mistakes have I made recently? So I've actually made a couple. Back in March, Uber and Facebook. Uber was at around $15 per share. It got down to around $15 per share in March. Facebook was around $150 per share. I knew that both of those were in my buy zone, okay? They were less than 2/3 of my estimate of intrinsic value for a share of stock. My value for Uber, I had around $36 per share, which really means if it's below 24, it's in my buy zone. And of course, I'm watching it go down to 15, and I'm thinking to myself, given what's happening in the economy right now, these things are just going to keep going down. So, why should I do anything right now? Why should I buy? And same thing with Facebook, down at 150. I have it valued at like $230 per share. It's in my buy zone, and I'm just watching it. I'm navel gazing as the stocks are sitting in my buy zone, right? And of course, I think to myself, well, things are just going to get worse from here. Suddenly, I put on my macro economic hat and think I can predict what's coming next. And of course, they both bounce back, and they bounce out of my buy zone. And I miss an opportunity to buy two companies that I'd love to own at very attractive prices. And now they're not at very attractive prices. So the lesson there was it's so easy to fall into the trap of thinking what's happened in the recent past will continue to happen, right? These stock prices have been dropping for, weeks, right? And I think to myself, oh, of course they're just going to keep going down. Like there's nothing optimistic in terms of what's happening in the economy that would make me think that these things are going to rebound. But that's not a hat that I should be wearing, trying to predict what's going to happen next. The only hat I should be wearing is, all right, here's what I think is the value of these stocks. If the price is significantly less, if I have my margin of safety there that I'm looking for, at least start to buy into those positions, okay? I don't need to plunk down, a 25% stake in Uber right when it falls into my buy zone, but at least start to buy in, maybe put in a quarter or a third of the whole position that I want to have in those companies. So that's the lesson. It was a hard lesson because I don't own either of them right now, as the price just continues to go up, particularly with Facebook. So that's the mistake I made. I didn't buy when the stock was in my buy zone because I thought I had some superior insights about what was coming next. So lesson learned on that one. And finally, number 5, what do I think of Tesla at $1,500 per share? Actually, I believe right now it's $1,542 per share. So I had a little conversation. I was having a chat with someone on, I think it was Meet Kevin. Meet Kevin put out a video, and I was going back and forth with another commenter in the comments, and he was kind of giving me his case for why he thinks Tesla is trading at a discount to what it's worth. I think his idea of what the intrinsic value of Tesla, he had it around 1,800, and so, you know, at 1,500, there's a slight margin of safety there. His big assumption there was that Tesla would be selling 6 million cars in 2031. Okay. Now, I don't know how he got that. I think most of how he got that is simply by looking at the growth rate of Tesla up to today. But, you know, in my mind, in the US, there were 4.7 million new cars sold last year. You know, this is before any kind of crisis, any pandemic, any sign of a recession. 4.7 million new cars, okay? And he's predicting 6 million new cars, 6 million Teslas to be sold in 2031. Of course, you know, Tesla is not just limited to the US, it's kind of a multinational company. But personally, I think auto sales are going to start decreasing, okay? I think with Uber, with self-driving cars, less and less people are going to own a car. And I think particularly less and less people are going to own a new car. So my sense of him just using the growth rate based on how many cars Tesla has sold from year to year, I think you got to put a cap on that. You can't just follow that curve to the moon. So Aswath Damodaran, who's a valuation professor that I follow very closely, when he valued Tesla earlier this year in 2020, he estimated that 10 years from now, Tesla would sell 2 million cars, okay? So you got 2 million cars versus this guy was thinking 6 million cars. Obviously, that's going to make a huge difference in the valuation of Tesla. So, you know, I could probably justify a valuation of Tesla somewhere around $400, $450. That wouldn't be crazy to me. $400 to $450 per share. At $1,500, I think it's very expensive. I think it's overpriced. Of course, when something has gone up for a while, it's up 4 times in the last 4 months, from like mid 300s up to 1,500 plus. When a stock has made a run like that, it's very easy for people to get excited about where it could go and have the blinders on and just be looking at that possibility of, all right, Tesla's going to the moon. And it's easy for people to forget about the downside, right? What could cause Tesla to drop from here? So, and there's talk about Tesla joining the S&P 500. Tesla right now, at its current market cap, would be like the 10th largest company in the S&P 500, which is insane. Now, would I bet against Tesla at $1,500 per share? Absolutely not. I mean, we've seen what's happened to short sellers with Tesla. I think it's silly to bet against a company, even if it's obviously a fraud, even if it's just the most ridiculously priced company you've ever seen. Because the best you can do when you're betting against a company, when you're shorting a stock, the best you can do is a double, okay? And that's if the company goes to zero. So, why would I want to make a bet where the best I could do is a double, and the worst I could do, Tesla goes to the moon, and I go bankrupt because I keep getting these margin calls. So, I think it's overpriced at $1,500, but I'm not going to do anything about it. I'm not going to bet against it. I would love for it to come back down and for me to get a piece of it at $300 or $400. I would, maybe put a 10% stake in at $300. So, I don't care that much. If it comes back down, I'll probably buy some. But it's such an interesting, everyone wants to talk about Tesla. It's just such a dominant story in our culture right now. And you can see tiny other electric vehicle companies that haven't even made a car, right? That are just going to the moon because everyone feels so bad about missing out on Tesla. They feel like they've missed this huge opportunity, and now any company that has electric vehicle in its description, it seems like the stock is just being pumped up. So it's a fascinating time that we're living in. But yeah, that's all I got for you guys. Let me know if you have any questions you want me to answer in the next Q&A next Saturday. And of course, I'll answer all of the comments, kind of give a short answer, whatever I can in a comment that you leave below. So enjoy your weekend, and I will see you guys in the next video.